A lot of so much in finance, and especially in the active management space, is narrative driven, which is, I mean, not necessarily good or bad. It just is. And then in the up years, like, man, your dad's made all the difference, right? It's like, and so it was cool as a kid to see that, but you also see like what made all the difference is like, hey, so '08 happened and somebody thought they were a long-term investor and their time horizon just went from 30 years to they have to pay the mortgage next month. All of a sudden, hey, you know where interest rates are at today? 4.2. So is it going to be a 1 or 2% drag on your portfolio over I think he used like a rolling 10-year period, maybe, but is the 2% worth the risk of a life-changing drawdown, right? A life-changing loss.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tall Oaks podcast. Today I am joined by a new friend of mine, Drew Feldman, who I started interacting with on X like a year ago, maybe a little over a year ago, something like that. So this is actually our first time really talking in person today, which is fun. And we've just done a lot of interacting on X in the financial kind of Twitter space. And Drew's coming on from Drew, you're out in California, and interesting kind of backstory on Drew. And what intrigues me and wanted me to have him come on and have this conversation is Drew actually, so he's a financial advisor out there and has a lot of thoughts on portfolios, portfolio management. And this is where we've conversed, but Drew didn't come out of the portfolio management space, right? Didn't get a finance undergrad or do a finance, graduate program or anything like this. Drew's a filmmaker by trade originally, and really more of a designer and an artist, and got interested in personal finance and started as this boglehead, low cost index fund, no one beats the market kind of investor. And the more he went and learned and researched for himself, it's changed quite a bit, I'll just say. And so I thought, let's have this conversation about where is this whole conversation about low cost index funds, active management. What is that? Is it good? Is it bad on either side? I thought it would be an interesting conversation to have. So Drew, I appreciate you coming on. Hope I didn't spill too much of the beans for everyone listening, but did I kind of capture the vision correctly there?
Yeah, you did great. You did great. You've been following me well.
Yeah. What was the first experience that, as a boglehead investor or as somebody that was really focused on just, hey, low cost index funds, buy and hold, it always goes up over time, change your perception to think maybe there's a different way? Like, was there a certain, like one particular experience or a conversation? What sparked all that?
Good question. I have to think back now. It's been a minute. I was a boglehead for a little while, and I think that it may have been a Choose Fi podcast. Do you know the Choose Fi? I think it's called Choose Fi.
No, I'm not familiar.
It's financial independence, kind of like a financial independence retire early community. I think there are a lot of bogleheads on there, and yeah, I think it was through that podcast I heard of a guy named Frank Vasquez, who I think I'm saying his name correctly, call him Uncle Frank, who has a podcast called Risk Parity Radio. And I started listening to a few of the episodes and realized that I knew so little about finance compared to what he knew. And there were all these pieces that were coming alive for me in his podcast. And then he turned me on to Rational Reminder. And it was really the Rational Reminder podcasting community that set me off. I mean, I spent hours on the Rational Reminder forum reading every single argument for and against, value, trend, momentum, and that got me over to academic papers. And then I was suddenly, writing screenplays during the day and, sitting in bed at night reading, the latest whatever paper that was coming out, maybe more lately on the fund manager side as opposed to the academic side. But, things like going back in time, right, to Fama and French's work, all the way up towards, Scott Cedarberg has some interesting papers on 100% equity investing. So I just found myself really drawn to it. And yeah, that just turned into a whole rabbit hole that I'm only now feeling like I'm climbing out of.
Yeah. So how did all that research change the way that you thought about investing? What were the biggest takeaways on that discovery process for you?
I think for me, I guess the starting point was I always appreciated the idea, even from when I first heard about sort of, buying the haystack, not the needle, even investing in, the SP 500, that you're getting these 500 companies and you're diversified. And once I heard the word diversification, that just became a goal and a value for me. And then I just came to learn that that diversification looked like more than just US equity beta. And so I think my general principles have stayed the same. I've always looked for diversified portfolios, not because I'm risk averse, but because there's just always been this natural sense of like, why would I concentrate and put all my eggs in one basket? It just seemed logical
Mm-hmm.
to diversify. And now it's very easy with so many ETFs hitting the market that are alternative liquid ETFs that you really didn't have access to five, and especially 10 years ago. Yeah, did that answer the question for you a little bit?
Yeah, I think so. I mean, like that's what you want to look for, but how has what did you learn in the papers that
Oh yeah.
kicked you off or on your journey to say maybe there's something more than just trying to buy the US haystack, right?
Yeah.
Um,
I would say the biggest pieces were just how much evidence, just so robust empirically, things like the momentum factor and the value factor and trend following, right? Time series momentum have over the long history. I was just blown away by it. And it just, I think we take for granted that equity beta just will always go up and up. But, you look at all these different strategies and these ways of thinking about investing in the market, and they all have a lot of empirical evidence behind them. So I think that was the first thing that turned me onto it. But then also, as a newer investor to the space, that these things were looked at from academics, and it wasn't just some, active discretionary manager trying to sell me, on 10 stocks that they wanted to buy. It made me more comfortable with the idea of sort of opening up to what else was out there. But yeah, I think just the empirical evidence behind it, and the fact that, I mean, I would say that plus the fact that these things are hard to hold and that there's some decent risk stories out there for them. And by that I mean risk stories meaning, presumably you're taking on risk and being paid a premium for taking on that risk. But I'm fine with the behavioral stories because, the more I look out at the markets, the harder it seems to hold these things. And then I think, well, what's my edge really? My edge is not that I'm smarter. I'm not smarter than all the PhDs and investors around the world every second looking at, what's happening in the stock market. I'm not smarter than them, but I do wonder if I could handle pain better than them. And I come from the world of film and television where pain is the name of the game in terms of just grit. And so I thought maybe there is a little bit of edge in terms of my behavior and just being mindful and thoughtful about fees. I never lost that. As a boglehead, I'm still mindful about what I'm getting, for value. Not to go too far off on tangent, but in certain ways, I am still a boglehead. I'm an expanded boglehead.
an expanded and enlightened boglehead.
Enlightened. Okay. I'm an enlightened boglehead. Exactly.
Yeah. I think your point about fees is really important, right? Like, so you can be mindful of them, and it just are you getting something in compensation for it? I think that for me, that's what I've been able to find when I review a lot of portfolios where active management's maybe gotten a bad name, where somebody, went down to the big box broker in town, in a strip mall or whatever, or XYZ, whatever. And someone loads them up with a bunch of mutual funds and like, hey, these are good mutual funds. And most people have no real way of understanding really what's in a mutual fund. Is it a good mutual fund, or what's in it, let alone what's the fee or cost. And it's because usually the performance that's shown people is net of the fee and cost, right? And so as retail investors, like the way historically would go is they would meet with some advisor or broker and they'd say, look, we've got these, 5 funds we think you should have in your portfolio. And here's how each one of us done on an annualized return. And, here's how volatile they are, how risky we perceive them to be. Right. And so people kind of go, okay, well, that seems like, I have no idea what we're talking about in terms of risk space, but I'll just take your word for it. And the return looks okay. You know what I mean? Looks good, I guess. And so, they buy it, or, the advisor gets it for them, whatever it is. And then, then I come along and I look at it and I'm dissecting this stuff and I actually pull up the metrics on it and really do some more statistical analysis on it. And you look at it and you go, well, you're basically paying 1.5% to, just have the S&P 500. You know what I mean? It's like, it's almost the exact same thing. The correlation is 99%, right? It's like, and in that sense, yeah, I think that's a fee not worth paying, right? Like that's generally not a good fee to pay. But if you start looking at it and saying like, well, it's a completely different type of fund where the correlation is, only 0.7, but it gets me a similar return to the S&P 500, then that might be worth paying a higher fee. What's interesting is I found that the newer funds that have come out in the last several years, the expense ratios actually are typically a lot less than 1%. The fee compression on funds have actually come down quite a bit. But trying to measure what do I get for the fee I'm paying is actually a little bit more difficult than most people give it credit for.
Yeah, that's true. And I think you have to, in order to get into the space, you do have to have a familiarity with what were people paying 5 to 10 years ago for the strategy, what's available if you want to pay for it.
Yeah.
And, these things are to some degree relative, right? Like I may value trend much more highly than I value, for instance. And so I'm willing to
Yeah.
pay for that. So there's definitely a personal piece to the fee side.
Yeah.
But yeah, and I think, yeah, that's an obvious example when someone's put you in a bunch of different equity mutual funds that might as well just be the SP 500, that you're paying
Yeah.
2 bips, right? So like that's a clear, that's a clear winner. But then as you're starting to get a little more into alternative investments, it can become more challenging to measure, how much value are you actually receiving per that unit of cost. And that's where you got to, do the research and dig in
Well, a lot of
to the
times
best of your abilities.
a lot of times there's really just there's not a great benchmark. So the reason that you can look at like an actively managed equity fund in the US and say, hey, is that a fee worth paying? Is because you can look at it and say, I can buy the S&P 500 for 0.02% a year, right? And so is this a good alternative to that, right? And the problem is like, if you look at it and say like, well, like managed futures, for an example, an asset class that has been proven to have alpha and no correlation to the stock market, right? Well, what's your alternative to buying managed futures? Like there is none. And every managed futures fund is actively managed inherently. And so they're all a bit different. So you can do a fee comparison amongst the funds themselves, right? To say like, okay, well, does something stand out from the peer group, right? Is one fund 0.5% a year and one fund is 3% a year, right? And you can evaluate that. But in that space, sometimes what's really crazy is like and I'm not saying this is the case, and I don't have any funds in mind that I'm thinking of or something, but like theoretically, the 3% fund could actually be a better fund to buy, right? Like
100%. And I think, some of the ways, just to get into it, like a little bit in the weeds, right? Some of the ways that I look at the value is how much vol am I getting in the managed futures fund? I think about that as sort of leverage.
Volatility. Yeah.
Volatility that I'm paying for the fee. How many managed futures is a great example of this. How many assets is it holding? We've seen there's a lot of evidence that shows the more assets you're able to put into the fund, the higher your Sharpe ratio, right? So as I'm comparing things, if I see, let's say someone's charging me 1%, and fund A has a volatility of, 8 and it's holding, 10 asset classes. Well, I'm just making this up or whatever. And fund 2 charged me 1%, but it's giving me a volatility of 13 and it's got 30, nice diversified assets that, classes that it's holding, assets that's holding in there. it's obvious what is the, I mean, it's not obvious what is the, let me re-say that. It's not obvious that's a better deal. We will never know. And,
Yeah.
until, X post, but it does get you directionally there, right? It's possible the other fund outperforms and but that's just resulting. That's not actually, thinking, from where you're standing right now, looking forward.
Well, there's two thoughts that come to mind on my end here is, this idea that look, a fee that you have to pay at the end of the day is a price that you are going to have to, it's actually a risk you're taking for the opportunity or potential to outperform, right? Like if you don't ever pay the fee, you are guaranteeing that you will not outperform, right? Or get any kind of better result. You pay the fee and you might get a better result. And I think well constructed, you can add products with mindful fees and be very likely to get a better result, but there's no guarantee to it, right? So it's a risk you're taking. But if you want a better result than a benchmark, then you have to take some kind of risk. You got to take it somewhere. You got to take it in the investments. You got to take it in the opportunity costs. You got to take it somewhere, right? And sometimes you have to figure out what does your outperformance really look like? Because some people really want to make more money in the up years. Some people want to not take as much of a loss in the down years. And some people just want to have, more by the final destination, but don't care about any particular year in between. Right. And all three of those things kind of lead you towards building a different type of portfolio. Right. The next that I had was actually, and I wanted to revisit what you mentioned, this idea of the volatility contribution in the portfolio. Right. So you kind of said something that's maybe counterintuitive for a lot of people. And he said, okay, so two funds are both charging 1%, and one has a volatility measure of 8 or 8 vol, and one's got 13. To make these numbers simple, let's go with 16. Is that okay if I change your example? Let's go with 16.
Yeah,
you know where I'm going with this.
Yeah.
So when you're looking at adding something like this to a portfolio, you can say, how does it change a portfolio? And if everything else about those funds is the same, but one has a higher volatility, most people would look at it and say, well, that's bad. You don't want more volatility, right? That's more risk, right? That's more risk. Well, you're trying to add a certain type of risk to your portfolio because of a non-correlation effect or capturing returns at a different time or a different way. And so it's intentional risk you're trying to add to the portfolio. But if your opportunity set is, well, I could add 10% weighting to this fund with the 8 volatility, or I could add 5% of the fund with the 16 volatility, half as much, right? You get the same amount of net total volatility on the portfolio, but now you're paying 1% on 5% of the portfolio instead of 1% on 10% of the portfolio. So actually that fee on the second fund that would be perceived as maybe more risky or more volatile on its face is actually cheaper. So it's actually lower cost in a way. What are you getting for the fee that you're paying? Right. And I think that's a conversation. That's where you're going with the volatility contribution, right?
Yeah, and of course, and I should have also mentioned correlation, right? If it has a lower correlation and a higher vol, that probably all things equal, that's pretty good for your portfolio.
A lot of so much in finance, and especially in the active management space, is narrative driven, which is, not necessarily good or bad. It just is, because if there's a narrative and it drives you towards taking action, and that turns out good, then net it was better, right? But if it drives you towards making a bad choice and it turns out worse, then that was the narrative. It's bad that it's narrative driven, right? But so there's narratives out there, right? Man, and I completely lost my train of thought on.
You were talking about buffered ETFs.
Buffered ETFs. Oh yes, thank you, Drew. Okay, so
are you a fan or are you not a fan?
It's an interesting question. I don't think they're neither good or bad. They just are, right? And so when you look at a buffered ETF, there's some people that are really tied to this idea that you can define some kind of outcome over a 1-year period, right? Hey, I've got a downside buffer. So if the market goes down, 20% and I've got a 15% downside buffer, I will only be down 5%. And I like being able to visualize that, right? And I can sleep okay at night and I can stay the course with that. And if the market goes up and it goes up 20, then I can get 17, but nothing beyond that, right? But I'm okay giving up that 3% as long as I know I'm not going to lose 20% if the market goes down next year. I'll lose a number that I'm okay with, right? And so you go like, okay, well that's interesting. And if that's what it takes for you to take action and get money invested, then maybe it's a good thing, right? But mathematically, and I've looked at a lot of these, you're better off taking, and if you say like a buffered ETF is typically a 0.5 beta fund, right? You're typically better off just own half of the amount of stock market as you wanted to hold and just go hold, T-bills with the rest of your money, right? You'll have, and this actually goes back to like, now that it's actually lower cost, it's just like net of all costs and net of all yields, you come up with a better result. Now, if you want to get super in the weeds for like high income earners that maybe have a low, threshold for, paying and taxable events, then like a targeted buffer ETF on a normal monthly series is actually an interesting idea. But I find like as soon as you roll that into something that's like consistently rolling or laddering out those buffered ETFs or trading through those buffered ETFs, you just degrade back to like, you're better off holding a little bit more,
That
S&P.
tends to be where I land on the buffered side, which is, I'll just tell you the truth. I'm interested to hear more about that distinct use case that you were talking about, because that is interesting. And it's not something I've thought about that deeply. My general approach is we can do this cheaper and more efficiently if we just hold less cash. If we just hold less equities,
Yeah.
and hold more bonds, cash, alts, whatever you want to do
Yeah.
on the side with that, right? And so why would we pay a fee to someone to run a buffer ETF? And I hear what you're saying. It might be able to help someone sleep at night. And I'm all for building portfolios that people can stick to. And I would never look down on somebody for that,
Right.
because we all have different emotional and psychological connections to finance and money. And there's genuinely, and with my clients and people I speak to, no judgment. Some people are really just more risk averse, and it's really hard for them.
Yeah.
And that's okay. And I think it's our job as an advisor to coach them and say, look, I understand this is hard for you, but you're working with me, you're paying me to help you. So let me help you. Let me coach you along. Let me hold your hand when things get tough, and let's do the more efficient, low cost investment option.
Yeah.
So I really, and I'm curious if you would actually expand more upon that use case for buffered ETFs. That's interesting, but really that's more like a tax play, right? Or tell me a little bit more about that.
It's a bit more of a tax play. The buffered ETFs roll internally, so there's never a taxable distribution ever out of them. And so if you look at like S&P, like an S&P ETF that's going to pay the dividends, well, you have taxable events, but then you also have all the taxable income from the T-bill yield.
Yeah.
And
true.
so by effectively taking that T-bill yield and rolling it into the option pricing, right, and the done package, you kind of shelter that. So if the tax drag would be big enough on the cash and the risk tolerance is low enough, and you're willing to do it in a targeted way instead of like something that's like a laddered fund,
yeah,
then you can capture it as an idea. But again, like a relatively low risk instrument, and way to go about it. Another interesting use case that I've actually had is like there's an ETF that I use that I trade that's a hedged equity ETF, and it's rolling the hedges internally in the fund constantly. It ladders them out 3 months and it rolls every 3 months, and so it gives the same effect. It gives this like half beta, exposure to the markets. Now that's an aggregate over time and space. That's what it averages out to, but it's not necessarily on a daily basis. What I found with this fund is the way that they actually design the hedges and write it. You do a very good job on the downside when there's a really bad, nasty market sell-off, right? So like April last year was a good example. Did a great job on managing the drawdown, but because they're rolling the buffers, what's effectively the buffers, like so quick on a monthly basis, they're selling the upside away too fast. And so you're not getting the recovery. So you do pretty good on the drawdown, but the recovery is really quite slow. And so like one way that I use something like that is I'll actually trade it. And so we'll own it for low risk clients in a way that it's they have a constant hedge carried, right? So you can sleep at night, like you don't have to be worried if the nukes start flying tomorrow, you've got a hedge, right? But after you take those big sell-offs, what we'll do is we'll actually trade it into just like a normal S&P 500 ETF. And thus you're removing the hedge, but you're removing the hedge to the downside after the market's already sold off, and your signals are kind of saying it's clear to go back in. And then because you've gotten out of the hedge ETF, you're no longer selling away that upside, so you can recover quicker. And then as the market recovers, you can go back to maybe running the hedge ETF again for just, hey, get the protection back on. But
interesting. So you're sort of outsourcing the hedging.
Yeah, you're outsourcing the hedging. So yeah, it's a way, like if you were running a hedge fund, you would just do that internally in the fund, right? Like you would just be rolling you'd be rolling your you'd be selling your calls and buying your puts, rolling it, and just after a sell off, you would just drop the hedging activity and just ride it up. Or maybe, dynamically change how much you're hedging. In the space that we work in, working with, like, you can't do that in people's IRAs. Like, but because the ETF landscape has changed so much post 2020, you have the ability to run something like this, right? And say like, well, look, we're going to buy the fund that we know what is happening systematically under the hood, so that you can outsource that. And you just have to, like, in my opinion, again, like going back to look at fees, if something like that costed 3%, I'd be like, no way, this doesn't work. It's too much drag.
Well, I was going to ask you, if you're already going in and making, well, I guess if you're already going in and making those trades, like, why wouldn't you just do what we just talked about, the buffered ETF, which is just hold more cash and then take some cash off the table and put into equities?
It's the opportunistic ability to drop the hedge and capture the upside. So like a buffered ETF it's gonna ride it down, it's gonna ride it up, right? So you get your hedge, but it's essentially, you can almost think about like the strategy that I'm trying to run is you're trying to monetize the hedge at the bottom.
Got it.
Does that make sense?
Yep.
So if you take a half beta drawdown, right? So like if and I'm totally just making up like numbers here, right? Just for illustrative purposes. If you're running a hedged fund that's only 0.5 beta, or like essentially half stock market exposure, and the market sells off 10% before like, all the signals fire off that say, hey, it's better off, you're better off just selling here than paying for more hedges. Well, you're only down 5%.
Sure.
Pretty palatable drawdown for most people. You know what I mean? But now the market's down at least 10, typically goes down a little bit lower. And so if you can capture and get back in at 10, the market's still down 10, but now you don't have any of the hedge to the upside, like where you've sold away the upside capture. And so as the market recovers, you took 5 on the drawdown, but you made 10 on the way back up. You get an extra, bout of outperformance, right?
Yeah, that makes sense.
Easier said than done.
Like you just have to be mindful of the fees of the hedge fund, of the hedged equity ETF. You be mindful of the transaction costs, things like that, for sure.
Absolutely. It's not something people should be out there like trying to do on their own generally.
Yeah.
I'm just saying, like, it is a use case for something that is a unique alternative product. Now, like, used in a certain circumstance or setting, all of a sudden it's something that, like, statically is like, that doesn't even make sense. Why does it exist as a product? Why would anyone own it? Well, it's like, because you can use it in a certain way, right? And that's what I'm trying to illustrate, is like, you can use these things in different ways other than just, hey, look at the, the fact sheet or the little sheet some advisor slides in front of you that says, this has done historically 8% a year or 12% a year or 3% a year, right? It's always about like the use case going forward and what value is it adding to my portfolio? How am I using it? And how am I thinking about it, right?
I think that, to me, is the most important piece, and sort of the missing piece of the puzzle is, and this is just something personal for me, I don't use alternative assets in my portfolio to outperform equities. I actually don't think over the long run I will outperform beta, except for the fact that I use leverage, in portfolios to increase the volatility for the alternatives. And so I think people look at funds on a standalone basis and say, well, this hasn't outperformed. And what you actually need to do is look at the correlations to the rest of your portfolio, look at the volatility, and look at the amount of risk you want to take.
Yeah.
And then that's where things get interesting, and where you could outperform, right? If you're levering things up enough, and or at least you can be on par with, say, that benchmark that you desire, which might be, like a total world equity portfolio, but you're getting there with less risk. You're getting there with a less bumpy ride, which some people would say, oh, who cares? Just like handle the bumps. But not everyone can do that.
Mhm.
And when things are really, really tough and really, really volatile, uh, monkey brain takes over. So I think for me, just as we kind of talked about, my move from Boglehead to more, let's call it systematic active management. I'm not a believer in discretionary, and in general, I'm a believer in diversification over concentration. I'd rather diversify and hold leverage than just be concentrated in a few names. Um, I think for me, it's less about outperformance and more about, um, the shape of your wealth over time.
Yeah, it's an interesting perspective. I always think about it through the lens of like, I've been around the industry for over 2 decades and have observed all these people over the years that, like, so when I was a kid and people would come up and tell me like, oh man, your dad, like has made all the difference. Right. And like, that's like the dot-com bust. That's '08. You know what I mean? Like that's like all those big market events. And then in the up years, like, man, your dad's made all the difference. Right. It's like, and so it was cool as a kid to see that, but you also see like what made all the difference is like, hey, so '08 happened and somebody thought they were a long-term investor and their time horizon just went from 30 years to they have to pay the mortgage next month, And so that instilled in me really this idea and understanding of like, it's really always easy to say when everything's good, hey, I'm a long-term investor. These are retirement funds that, I'm 35 and I'm not going to retire till I'm 65. I've got a 30-year time horizon. All the empirical data says stocks will be higher at a compounded growth rate of 9 or 10 or 11% a year over that time frame. Let's model it out. That's what I want. You know what I mean? It's like, if something happens, I won't need the money. Like I won't touch it. It's like, it's easy to say that, right? And then all of a sudden something happens in your life, right? Whether it's an economic event that changes and you lose your job or you lose a family member, or there's a disability in the family or whatever it is, right? Like, and all of a sudden you go from like, hey, I thought I was a 30-year investor, but something really went wrong. And we already blew through our savings. Like, and there's no end in sight to this. And like, we saw that in '08, like I was around for that in an unsavory way that most kids probably didn't have to like think about or deal with or
Yeah.
like, yeah, but it was like people lost their job in '08 and like they went unemployed for years. You know what I mean? Like, I know that we had clients at our firm that, like I've heard the stories where they lost their job in '08, '09, and they called up and said, hey, I'm just going to have to cash out my IRA, just send it all out. And, and my dad's response was like, hey, listen, like, don't you don't have to cash it out because you lost your job. Like, let's cash flow out of it, but we can recreate your paycheck here. And there was people that like, it lasted them, right? And it set their retirement way back, but they didn't lose their house. They didn't, go without their kids ate and this sort of stuff, right? And you could make that stretch and it saved thousands, countless tax dollars, I'm sure, making, some better choices here, but you were able to kind of continue as markets recovered, grow some money before you had to use it and all this kind of stuff. But it quickly came from, I was a 30-year, time horizon to now I'm a 3-month investor. And
Yeah.
that tends,
I think too, like you're seeing a lot of people. Oh, sorry to interrupt you there.
I was going to say, it seems those two things correlate, right? Like the correlation of, hey, I just on average, like, hey, I just became a really short-term investor and hey, the markets are crashing, seem to correlate together. Right.
Right, exactly. They have a funny little coupling there, don't they? They seem to like each other. Yeah. I mean, it's funny you're talking about having a shorter horizon and, just to try to be a little bit self-aware and some analysis on my own psyche, which is, I lost my father when I was 6 years old and I watched, even as a young kid, like I heard stories about how, thank God my father had a boss who helped my mother, think through investments while she was managing grief and 2 kids. And, my father, who was diagnosed with cancer and 2 years later was gone, definitely thought he had a 30, 40, 50-year horizon at
Yeah.
least in terms of investing. And he didn't. And so I do think, yeah. And that also, certainly for myself, has meant that I hold a little less beta and I hold a little less equities and I hold a little bit more in terms of the alternative assets and just, personally. But I also think that you see a lot of new people to investing who've never really, they started investing after 2008 and maybe things got a little shaky in 2022, but they're just VOO and chill. And they got lucky these last 10 to 15 years. And maybe they've been lucky in their own life to not have to face something, so difficult as some of those clients that you mentioned. But I'm cautious about even though I am at the end of the day, I am at my core and I weight portfolios towards this, a believer in markets over time, in equities over
Yeah.
time, and people going and showing up at work and producing, real things for real people and providing cash flow to investors. I'm a believer. I'm a believer in the United States. I'm a believer in, global equities generally.
Yeah.
And yet, life happens. And I do think that's where some of these other investments that I think you and I are interested in, and maybe as well for yourself, like I imagine, I don't know, I'm just, I'm psychoanalyzing you here, but having grown up with your father as an advisor and, a CPA and seeing that in your informative years, I'm sure that influenced, how you think about investments.
Yeah. Yeah. I think I'm probably actually considerably less risky than most people perceive me to be. Um, I'm okay with risk. I just like calculated risk.
Right.
I mean, risk is what you're compensated for at the end of the day, right? Like you're only ever compensated for risk. There's no risk-free money out there.
And by the way, that's something I often tell people that are hoarding a bunch of cash, right?
Well,
meaning risk if you do, risk if you don't. Like there's risk everywhere you look. Everything is a risk.
Yeah.
And you have to be willing to tolerate it to some degree, but even not investing is a risk.
Yes. Yeah, absolutely. I've done podcast episodes on that for sure.
Oh, cool.
I'm a big fan of the saying, right? Like risk is like energy, right? Can't create it, can't destroy it. You can only convert it.
Yeah, I think I first heard that from Corey Hoffstein. I think,
yeah.
I'm sure somebody.
Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. Actually, the first time I ever heard it, we came up with it. A guy that works with me that we went to school together, we were sitting in the office one day and we had come up with this idea of it and we thought we were like so smart. And then we're like, oh, a ton of people have already said that.
Yeah, but it's cool. It's still cool. It's still cool when like you come to it on your own, right?
Yeah. But
it meant that you actually sat down and had put enough thought into just and to inform your investment philosophy and your philosophy of finance generally to come to that, like says you're probably on the right track.
Yeah. Well, and props to Corey, because I think I've actually seen people attribute that to Corey, and Corey does always such a good job of saying, hey, I give credit where credit's due, and he'll actually cite where he maybe heard it from first or who said it, right?
Yeah, but classic that neither of us can quote anyone before Corey.
Yeah, right. Corey's a stud.
Yeah.
Anyways, what I was going to say about cash is like, there's probably a lot of people in this thing that were like, well, if you can't be a long-term investor in S&P 500, you got to just hold more cash. You got to have a bigger emergency savings. That's why you have an emergency reserve. So like have more emergency savings. And I don't know, like, tell me if I'm off base here, but my thought on that is like, well, okay, but you're no longer all of a sudden, you're already now not 100% S&P investor, right? Because if your emergency savings, like if your portfolio in the S&P 500 is 100,000 and you keep 100,000 in money market as savings, like my friend, you're a 50-50 portfolio, right?
That's
like,
right.
And your bond side is really inefficient, and so all of a sudden it just circles back to like, well, most people probably are something more like a 60-40 investor. Like I think a lot of people aren't actually as aggressive as they think they are. And when they are being as aggressive as they think they are, they're oftentimes almost being more aggressive and a lot of times, in my opinion, borderline reckless. Right. But
I'm curious if you'll tell me what you think about this, but it drives me nuts when people say to me, just what you said, right? Like I'm 100% in equities, but they're holding a bunch of cash in their emergency fund. It's like we have to look at your whole, like
Kind of
money is
like, yeah.
fungible. We have to look at the entire portfolio, right?
Yeah.
And just like you said, and I'm curious what you think too. I right, like I often think, okay, yeah, let's use your example. And now, the stock market has gone up a ton, and you are suddenly, it's like 75-25. Are you now going to sell some of your equities back into your emergency fund of cash? Is that what you're going to do? Like, you know what I mean? Like
It,
people are like, oh no, I'm not going to do that. It's like, oh, so I don't think people really do understand their portfolio and their risk tolerance. But I'm actually curious what you think about emergency funds generally.
yeah, I think most people they carry too much risk in their investments and they carry too much emergency reserve. And I think the easy way to sum all that up is probably they're not as efficient on their bond and alternatives strategy as they should be is probably the net result. But so I'm in a master's program up at Utah Valley right now, master's of finance in the wealth management track. And it's really interesting. I'm always trying to give people feedback and like, hey, we're studying all this stuff in theory, but like, let me tell you what I actually see in the field, right? Like, let me tell you as a practitioner trying to go through this class and not rip my hair out, what real life is like here. And so a lot of times I'll see people like in case studies and they recommend like, okay, so-and-so needs to like have, 6 months worth of cash to cover all expenses in their life. And, cause that's like what's prudent. And I'm like, well, why 6 months? Right. And my observations are generally like, hey, you have the ability to pull money from investment portfolios, right? If you have to. But also like if you have a disability policy through work with a 90-day elimination period and it's 60% of your income, but it's tax-free, you might need something that looks more like a 90-day, like a 3-month emergency reserve. And then you have to look at it too and say like, do you really need 3 months of your current income or your current expenses, or do you need 3 months of keep food on the table and the mortgage paid, right? Like,
Right.
And I think it tends to be that, right? So I'm a fan actually of, trimming down the emergency reserve a bit, utilizing things like quality insurance ideas, like disability insurance, right? To manage out that risk, because you can say, well, I can invest with a little bit more confidence because I know that I need to bridge a gap for 90 days and then my disability policy kicks in. And even if that's a little bit of an income gap or something, it's going to maybe change the way I invest. I've got time to manage that. And I've got the ability to potentially stay invested anyways. And so I think what people do is they end up trying to take too much emergency reserve. All right. They don't think through that. And so they just think like, well, I read 6 months is good. So I want 6 months of my current income. And it's like, you make $200,000 a year as a family. So you're telling me you need $100,000. Like the reality is, are you both going to lose your job at the same time? You're both going to get disabled at the same time. It's like, you're probably being too aggressive on the amount of cash you're going to hold. And then what always ends up happening is a byproduct of that is when it gets to their portfolio, they say like, well, in order for me to retire on time, I'm going to have to be really aggressive on these returns. So I'm going to go way down the risk spectrum on risk. I'm going to have all kinds of risky behavior in my financial life. And they feel a little bit more okay about it because they're like, I'm not going to need this money. I've got this huge emergency reserve. And my observation is generally like going back to the same conversation, like, hey, you're not 100% stock portfolio, a stock investor, you're a 50-50. It's like, you're better off running a 70-30, right? In terms of like, hold a little bit less emergency reserve, but then maybe have not 100% stocks, but maybe 80% stocks, 20% bonds or something, right? Like, I mean, you can do the math to really figure out what somebody kind of needs, but just
I think what you're
tune it down.
what you're
Just be more
talking
prudent.
to is I think what you're talking to is like what makes you a holistic planner, right? It's like not just about the portfolio. Let's think about your disability. Let's think about your insurance. Actually think about your actual needs and what's actually going to happen in an emergency situation. And that's the difference between like our old school financial advisor just managing your wealth, and someone who's really strong on that. And also, let's look at the total picture. And also, there are so many other levers to pull when it comes to emergencies. And generally, I was going to say I'm in a similar boat to you in terms of I think most of us, if you have a sufficient enough investment portfolio, could probably hold less cash in emergency funds. And you should work with an advisor who's able to look at your portfolio holistically and help you think through that.
Yeah.
And at the same time, I think there's also there is something to be said for. I think about this with like, I'm saving up for a down payment on a house, right?
Hmm.
That's like an intermediate portfolio time horizon,
Yeah.
and it's really not talked about a lot. That's sort of like 10-year horizon in finance so much. I do think there might be a difference between it's like you kind of have to do both sometimes. Look at your portfolio holistically, but also if money is actually earmarked towards a certain need at a time, an actual liability, I think you could make an argument for in your mind separating it out from the rest of your portfolio
Oh yeah,
because, because
absolutely.
because it's not for retirement, right? It's for something else. Whereas an emergency fund to me, just to get back, is still, and I'm just sort of thinking about this and saying this out loud for the first time. It is sort of part. It is, even though it's about dealing with your emergency now. What are we really talking about? It's about maintaining your wealth over time so that you can get to retirement and do retirement. So it's still part of your retirement plan, your
Well,
retirement strategy.
well, okay. Yes, I can agree with you that when there is a time phase goal that you can earmark money off and have this separate pot, but having it be necessarily completely outside of the portfolio or outside of the plan, all of a sudden, like that, you can do that. Also, what you can do is say, hey, we're going to invest this thing that's within the next, we hope it's going to be within the next 5 or 8 years or whatever, that we're going to build a vacation home or something, right? And you're like, but if I get disabled or laid off from work, we're probably not doing that anyways. So that can be like the second layer of our emergency reserve, right? Like we're all of a sudden the money we're saving up to do that, we can now use for helping fund this, whatever tragedy in life that comes along, right? It's so all of a sudden it is calculatable or includable in the plan. And the net result is just, listen, this is natural. It's like, as you get more money, you're going to be less risky as an investor. You should be less risky as an investor, right? Like you should be more diversified. You should have access to more asset classes. You should be doing that kind of stuff. Listen, if you have, and so I think sometimes we always think like there's always this big push to passive, and I think like there's a certain person, it's kind of like the loud minority. I think a lot of people when I've had these conversations are really reasonable and they go, actually, that makes a lot of sense. Okay, like yeah, I can see that, and they're really sensible and coachable about this. But like, man, you look at the whole thing and it's okay to just not be chasing returns every single year, just you're trying to get to places comfortably and on time. And it's okay to, say, hey, I've got a bucket of money that we just run lower volatility and, maybe lower risk. And we're trying to do something like, more return than cash, but less risk than stocks. It's like there's something in the middle, because what about stuff that comes up in the midterm, but we don't really foresee anything being midterm? It's okay to run it that way, right? And earmark it instead of just saying, well, we'll run targeted 60-40 portfolio, right? Like, so you can bucket things out. It's just different. And it's okay, but you have to like be realistic with yourself. Look, if you're starting out, right? I've brought people on at this point now that are their clients, and they come in and their initial thought is, I wrote out '08 and I think people would have a hard time beating the market. So I do have sort of a hard time with this whole, any active decisions, anything, right? It's like they're all in on passive and all in on the Vanguard, data points. And I just go, yeah, you rode through '08, but like, listen, I can do the math here really quick. You started investing in '06. So '06, you put $5,000 in and you made a little bit of money. And in '07, you broke even. Now your balance was like, let's call it like $11,000. And then in '08, you saw it go to 5,500. You put 5,000 in and you're back to 10,500. You really didn't like notice it, And I just go like, so now if we just play that forward though, You now have $1 million. You're all in S&P 500. If you wake up next month and it's 500,000, guess what you can do? You can go put your $7,500 in for this year, right? It's not even going to make a difference. It's not going to help you buy the dip in a meaningful way. It's not going to help you, right? Like there's no dip to buy when you can put in $7,500 and you just lost $500,000, right? Like, so you got to think about that entirely different in these like life-changing market events. And people have a hard time thinking about that until they finally think through, oh yeah, hey, I've bought dips and it worked well, but that was also unique. And when I did go through crazy market events, like I had a job, I had cash, I was putting money away, and that money I was putting away made it feel like I didn't even really lose a lot of money in the meantime, right? And so when things recovered, I recovered really quick. And so I thought it was great. They enhanced their return. Like, and I'm happy for all those people. Like, I love that for them. I love that for me, right? Like, but on a go forward basis, when you start thinking about it, like, hey, it's not a 50% drawdown. It's a $500,000. And all of a sudden they go, ooh, yeah, that's actually not, that's, I'm not loving that, you know?
Yeah.
Hey,
that's true.
We got to back off the risk somewhere, you know, we got to add the diversification. And the holy grail of using alternatives and diversification and leverage is to try to say, hey, can we enhance the diversification to a portfolio in such a manner that when stocks sell off 50%, right? Do we have something that is doing good or at least not doing bad, right? And so the whole portfolio isn't down 50%. Now, we might have to end up using some leverage to, in otherwise across time and space, get something that still looks like a full return of stocks, just being 100% stocks, but you can try to avoid that massive catastrophic issue, right? I think like managed futures is one of the greatest asset classes to point to, like the sustainability of that concept or idea, but it's just such a weird mindset shift from, I'm just going to say like old school investing of, you know, buy a good stock that pays a good dividend kind of idea, right? And just hold on and hope your dividends come in. I think that I wish that way of investing would come back. Like, I wish it would. Like, my life would be actually a lot easier in a lot of ways if we had a market that functioned on the fundamentals, right? Like,
sure.
But do we?
It doesn't appear to right now. I mean, at least not from the research I've seen, where, you know, earnings and valuations are still pretty high, and earnings have increased, but not quite enough to justify it. And I'm sort of agnostic to the whole idea. I do think these things wash out over time.
Mm-hmm.
Yeah.
Well, that's
so. It's everything that you're saying really, you know, resonates with me, because it's how I think about investing. It's how I think about markets, and just something, you know, we obviously met because we had this shared language and shared philosophy. And sometimes I forget that we're a very, very small corner of the market.
Yeah.
And most people are still interested in buying that stock because, you know, the vacuum machine works really well.
Yeah.
So it's probably a good business, right? And sometimes I talk to people. I've only one time, and this happened maybe a month ago, have I been out in the wild, in the normal world, and someone said to me that they had a managed futures fund. Only once. I've never met anyone who had any idea what trend following was. And I've asked a lot of people that are investment savvy, that are working in private equity or over here. And again, I'm not talking about people I've met through the investment world. I mean, just in my larger bubble of smart, you know, educated professionals. Nobody has a clue. We're, you know, and so to me, that also gives me more conviction, you know, in these strategies.
Well, you know, here's the thing is, like, until 2020, you really couldn't get managed futures in an ETF. You could get them in mutual funds, but even that, like, that was super opaque. And prior to that, they were just exclusive to hedge funds. So 15 years ago, the only way you were going to talk to somebody that knew what managed futures was and had it was somebody that had ultra high net worth. I mean, like ultra high net worth. And they had an allocation out to a hedge fund, paying 2 and 20, right? 2% a year plus 20% of the performance in fee. And like the
Yeah,
investing
you're right. We
landscape
didn't
has
have
just changed.
access, and
Yeah.
also, for that particular strategy, 2022 is great to it, right? So you also suddenly have a lot of interest coming after 22 because suddenly it popped off after, I don't know, like a decade,
Yeah.
right?
But then like, just as managed futures always has, like what happened after 22? Wah, 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 nothing,
Yeah,
you know?
yeah,
Right.
yeah.
Like, so it's a tough asset class. And if you don't understand it, it's tough to implement it. Right. And it's one of those things that, like, when the market's great, it might literally be just doing nothing. And you're just like, why do we even own this thing? Right. You own it. Like, it's going to work when the time when you're like, don't want to own anything almost. Right. Like that's how managed futures tends to work. And, I will say, like, the one thing that I found useful in talking with clients about what managed futures is, I tend to use managed futures funds that don't trade a lot of equities in them, if at all.
Mhm.
And so a lot of the positions in managed futures are typically commodities, right? Like, just the nature of it. So I typically tend to explain it to people like, hey, look, it's not stocks really. It's not necessarily bonds. Most of it is like commodities. And the idea is that commodities, when they're going up, they have the ability to hop on and capture the trend. And so they can make some kind of return from commodities that are going up. Likewise, if commodities are going down, they can flip to the other side and they can be selling commodities while they're high and selling them, while they're high and maybe, buy them back lower. And people have done okay envisioning it that way. Like, just thinking like, okay, so it's not stocks, it's not bonds, it's commodities. Commodities move all over the place. Okay, I know, orange juice isn't like gasoline, and that's not like natural gas, and that's not like gold, and that's not like, you know what I mean? So there's all these different things. Okay, I can see how there's diversification here. And they go like, okay, it just seems sensible. It is a little bit tough when it's not working, but again, what's interesting about managed futures is it's usually not working when everything else is. So it's like just annoying, but it's not like costing you a lot of money, right?
Yeah, most people
You
are
know,
not sizing managed futures to be such a huge portion of their
yeah.
portfolio.
I mean, maybe
Yeah.
they should, but it's tough. It is.
Yeah, it is. I mean, yeah,
It's really tough. You almost
it's,
have to run. You almost have to run leverage to use managed futures in the most interesting ways. Like a true portable alpha idea, you're going to use a lot of leverage,
yeah, for sure.
and um, and the nature of that is, on a day-to-day basis, your volatility will be higher than it would otherwise be, right? So you get the diversification, like it, and this goes back to, like, there's no free lunch in finance, right? Like, there's no free lunch anywhere, right? So you can add managed futures to a portfolio, Drew, but, like, what do you give up? You give up the normal day-to-day ride being a smooth, because you're trying to smooth out the big dips, right? The 2022s, when you have something in the portfolio that instead of being down 20% is up 20%, right? Like, that's what you're trying to go for. But in exchange, you give it, like, on a week to week basis, it's a bit higher in the movement, right?
You also
Um,
might give up your sanity.
you could, if you,
Yeah, I mean, if you think about, it's funny, we're just talking about managed futures trend, but there's so many other pieces that you can add to a portfolio that
yeah.
are useful, and things like reinsurance, and there's all sorts of stuff, and merger arb, and
Oh, like, dude,
uh,
I've been looking at, and I've been a little bit involved with, like, catastrophic bonds are in an
yeah,
ETF
yeah.
now, right? Like, the correlation is like, I'm really watching to try to see how that correlation pans out, but correlation is like not existent. It just,
Yep.
because it's like,
and,
what?
and and there's a clear risk premium there, right?
Yeah, yeah, and
And I
it's
and I and
healthy.
I
It's a healthy
favor. I don't know
amount.
about I don't know about you, but I do favor my portfolio. I weight my portfolio is built for clients. I do weight them based on my perceived uh, ability to understand whether or not they're giving me a risk premium versus a behavioral premium, right? So, like, I do weight risk based assets higher than assets I think are just going to do well because of behavior. Like trend, just to be honest, I'm not really bought into the risk based story on trend or on managed futures. I think a good chunk of it is due to bad behavior, so it does get a smaller weight for me than it might otherwise. Compared to something like, and again, this also talks about fee and cost, whereas something like reinsurance, it's just very clearly a risk premium, right? Perils, bad weather events, um, shouldn't be correlated to the markets, over
Yeah,
time.
Well, you have capital markets and you have risk transfer markets. And I think truly diversified portfolios have a combination of access to both. And
Mm.
that's something that I've really never hear other financial advisors talk about. But it's the idea like your capital markets are, that's where capital goes to be created, your capital creation markets. So like the stock market, right? You go to give money to a company that they're going to invest in their operations and right. Like that's what buying a stock is, right? Like, I mean, obviously if you buy it on the secondary market, it's not the same, but that's what that market exists for, right? Is to give Elon Musk money and funding to build Tesla as a company, right? Like that's the point of it. And so you're trying to put capital into that market to grow it that way. Or you're trying to borrow money. Like somebody who wants to issue, who was it this week's issuing a 100-year bond? Oh man, Google's issuing a 100-year bond this week, or they announced they're going to. And so like you're borrowing money to Google because you think they're going to go out and use it, right? So it's this capital creation market. And then the risk transfer market is oftentimes referred to as like the derivatives markets largely, right? But like futures, for example, right? So people think of the risk transfer market as being this net zero, like, hey, there can only be as many winners as there is losers, but they think about it on a net, like a net basis in a vacuum. And so what they forget about is like, there's a real business use case out there for the risk transfer market that is so important for the functioning of business. And people are willing to pay a premium, and essentially like they're effectively signing up to say, hey, I'm likely to be a loser here, but I'm happy if I lose on this deal. Right. Like, and that's unique. That's really unique. But, a good example would be like, an oil driller, right? Like somebody in the business of oil, right? And they say, hey, we want to drill another well. And because oil's at $60 a barrel, and if oil stays at $60 a barrel, we're going to make, X amount of net profit. But if oil goes to like something happens and oil goes to $40 a barrel, we are going to be absolutely like, can't do it, right? We're going to go bankrupt over this decision. So in order for us to drill this well and make any money at all, we're going to go sell futures contracts on oil at $50. We're going to pre-sell the oil. And that's all they're doing, right? They're transferring the risk of the future price movement to somebody else and saying,
and they're
hey,
and then they're paying the premium for it.
They're paying the premium in a futures contract if oil goes to $70 a barrel, and they could have made a bunch more money, but they don't look at that activity and say, man, look at all that money we lost in the futures market. They're like, dude, look at all the money we made by locking in at $60 a barrel and dropping a well in the ground and getting it all, and so that gives you the risk transfer market.
And look how great this was for our business. And
they're
for the investors of our
they're
business.
happy, and they got.
Sure. I've always liked that risk explanation for the futures market. I think my concern has always been that maybe like the financialization of it has sort
100%.
of knocked that opportunity out a little bit, which is why I'm again, this is another area where I'm agnostic when it comes to managed futures specifically and trend specifically. I'm sort of like, yeah, maybe there's a risk story over here, exactly the one you talked about. Maybe the financialization has come in and sort of knocked that opportunity away. But even if it has, I still think people are great at exhibiting bad behavior. And I still think that trend can profit off of that bad behavior, right? Just like the classic momentum story.
100%. Right? But what I'm saying is like but you can't capture that premium. You can't capture that return if you don't add risk transfer. Anything that has to do with risk transfer, if you don't add it into a portfolio. That's my point, right? Like there's this whole other segment of financial markets that people just dismiss that they exist not to just for people to like have some obscure bets with one another. It's like it's there for a real purpose. Now,
this isn't Kalshi over here. Like, exactly. And also, people are like, oh, I have equities. It's like, I have the whole market. Like, no, you don't. The whole market is an aggregate of all of these different asset classes together. If you're the average investor, you should be holding some commodities and some crypto and, et cetera.
Yeah, no, I generally agree with exactly what you're saying, but yeah, even if
who knew I could get so passionate about people referring to the market as just equities.
Yeah, right. But that is true though, right? When people say like, hey, don't buy the needle, buy the haystack, and I'm like, but you're deciding to only buy that haystack.
And this is to go all the way back to our initial conversation about being a boglehead, right? When I finally understood that equity beta is just one source of risk, and I could be diversified across other sources of risk. And I heard this from Larry Swedroe initially, and he has a great way, and I still think about this, a great way of analyzing what kind of, alternative strategies, assets should you go after. And he says, it should be something that's pervasive, persistent, robust, implementable, intuitive, right? And again, this is just a made up framework for him, but they're just rational, it's logical. And you think, yeah, these things, like we talked about, value, which is another risk source that you can get alongside beta, momentum, profitability, quality, trend, and time series momentum. I mean, we can go on and on, right? To other things. I think for me, that once I realized that the Bogleheads were actually pretty concentrated investors,
Mm-hmm.
that opened me up again, because like, oh, I don't want to be so concentrated. I think the Bogleheads are actually pretty risky.
Well, I actually very much agree with that. And I think most people in 2EV actually think they are too, because that's why they come in and see people like us as they come closer to retirement and they say, I'm really nervous about the stock market. and all the Boglehead framework says it doesn't matter. Over time, it just goes higher, right? And they're sitting there saying, that's really nice, but I'm trying to retire and live a real life. And they're, it keeps me up at night. What if the stock market crashes? It makes me nervous. And so they're saying, I've got the haystack and I'm not feeling too good about it, and people self-identify that to us. Now, it's unfortunate because a lot of these people across the US, as they hit that retirement age, they go into places that, instead of helping somebody get diversified, they say, well, we just have to take a part of your stock market portfolio and buy you an annuity. And, they make some big commission selling the annuity and then just leave the rest of their portfolio in a bunch of stocks still. And they could have just diversified the whole thing out, maybe done a more comprehensive financial plan. But I digress, that people know that being all in the haystack or owning just a haystack, when rubber really meets the road, and you need a portfolio to perform and do something for you in real life. And it's no longer this theoretical, I've got, a 30-year time horizon. And if things don't look good, I'll just tell myself I've got a 40-year time horizon instead, right? Like they're like, no, I've got all of a sudden a really in my face time horizon. And it's keeping me up at night.
Yeah. And I think I'm personally, I've always been willing to sacrifice returns for a little bit of safeguarding myself from my own worst behavior. I've talked about this on other podcasts. I set my whole life up that way. I try to build, I just assume that my willpower is low, and I try to, and that I will make bad decisions, and I try to build my life in such a way that I create guardrails so I don't.
That's it. That's interesting. And a really good self-awareness, Drew. There's an interesting stat I saw from, there's a guy, Jim Paulson, he's an economist. And he did a study, and he basically showed that what's the effect, what's the drag caused by having bonds in a portfolio, right? So over time, based on the interest rate environment, how much return drag are you going to have by having a 60-40 portfolio instead of a 100% stock portfolio, right? And what you saw in this study was super clear. It was actually, this is what made it so intriguing, was that there was a really clear definitive line. When interest rates are below 4, it's a huge drag, right? It's a massive drag. When interest rates are above 4, and this is, I believe he was using the 10-year treasury in his study, the drag shrink to 1% or less on average. It's actually really low. And so you look at all that and say, hey, I can understand why recency bias, the last 15 years when we were in zero interest rate policy, everyone concentrated out into stocks, said bonds are a bad deal because candidly, mathematically they were, and everyone got to this one side of the boat. All of a sudden, where interest rates are at today? 4.2. So is it going to be a 1 or 2% drag on your portfolio over I think he used a rolling 10-year period. Maybe, you know what I mean? But is the 2% worth the risk of a life-changing drawdown, right? A life-changing loss.
Right.
That's it. And look, to some people, again, depending on their stage of life, their life circumstances, their account balance, the answer might straight up be, no, I would absolutely rather have the 2%. In fact, how can I leverage up? I'm willing to take way more risk than that even. That is a real and an okay conversation. But most average people, if you don't understand the stock market, you don't understand investments, like you might be better trying to say, how can I add something to my portfolio that closes that gap, that 2% gap, but I don't need it to go negative. I don't need to outperform necessarily. It's like, is there a way that I can be diversified and close the gap? And I think that's where looking at a lot of alternatives to add into a portfolio makes more sense, right? Because you shave off inherently what you end up doing, unless you're running portable alpha, is you end up shaving off some of the stocks and you end up shaving off some of the bonds, and you're adding something in the middle that is probably going to produce a bit more return than bonds. It will probably increase your volatility on the portfolio a little bit, but it's going to add a completely different income stream or like return stream or drivers of return to the portfolio and make it so that the portfolio is a little bit, smoother across time and more diversified, but you're not really sacrificing much of the upside capture per se. So
I think I'm obviously 100% in line with you, and that's absolutely where I am philosophically. And to give credit to the other side, because I do like to look at both sides, I think there is something to be said that when we're looking at the expected return of some of these alternative asset classes, it's difficult to measure compared to something like bonds or stocks, right?
Yeah,
that
sure.
have cash flows and that you can actually measure the expected returns. And when we're looking at alternative assets, we're really looking at things historically, and we're trying to use, volatility. But to my favorite, I call him, he's like my investing rabbi, Antti from AQR, and he says, it's really noisy, even with all that information about bonds and equities. It's really noisy, especially with equities, to look at expected returns. And it's actually much easier to look at volatility, expected volatility or expected correlations compared to returns. And you can do that with alternative assets.
Yeah.
And I think people also kind of throw that out as well.
Yeah. It's all interesting stuff. And I think, I can't even imagine there's anyone out there that's even still listening to this conversation.
No,
I think
not.
we're so deep in the rabbit hole. Drew, this was maybe a bad idea.
That's okay.
This is Brandon and Drew up on their soapboxes about alts.
I know. I mean, but hey, no one else is. I mean, usually, to be honest, the people that are talking about these things are the ones selling you the alternative assets, which I get it. They should, and they are oftentimes very educational and very learned people as well. But what's really cool about what you and I do is we don't get paid based on the assets that we recommend people. I don't think you do.
No.
I'm pretty sure you don't. We get paid to help people build a holistic plan that is useful and meaningful to their lives and their goals. And we're just trying to find the best ways to do it. And I don't know, I have yet to see other advisors come together outside of like Rational Reminder talking about some of these things, some of those guys at PWL. I have yet to see a lot of advisors coming out actually speaking about this. So just something to say. I do think it's relevant and useful to the podcast marketplace.
Well, yeah. I mean, in practice, the reality of it is it's tough. It's tough. I mean, most advisors don't understand. Like, you and I both know most advisors are, client relationship managers, right? And so it's tough to understand, right? Like it's tough to understand when you start talking with most advisors about risk transfer markets and trend and volatility scaling. They just don't. They have a hard time getting it, and unless there's somebody giving them that mentorship, right? And then the second component is like even if you educate the advisors, compliance has to sign off on it, right? Is compliance going to allow them to even use it, right? What I found is that bigger investment shops, a lot of times it's not even really about the compliance. It's that the fund company has to be willing to do some kind of revenue share on the backside. That's like, in my opinion, it's a big breach of fiduciary duties, but there's still business on the backside of all of this that no one likes to ever talk about at the big shops. But at the big shops, that's what tends to happen. I'll just say. And then if you get past those two hurdles, so you're an advisor that understands it, your firm will let you do it or, utilize these type of things. Now you have the next hurdle, which is, trying to explain it to a client. And even if the client says, hey, we trust you, No worries. You then still have to, you take the career risk that you look different, right? And at the end of the day, the finance industry is largely built on, at this point, the idea of don't look too much different from anyone else. Because if you don't look too much different from anyone else, people don't want to move money. They don't want to change. They don't want to do, you know what I mean? Like, it won't ever be compelling enough, right? If somebody says, oh, look at your guy's portfolio, he's only gotten you 11.8% the last trailing 7 years, and we would have done 11.9. Somebody goes like, it's just not worth the hassle. My other guy's nice, whatever. It's like, this seems irrelevant, right? And so people want to not look different than what CNBC says they should look like, right? And that's, it's actually, in my opinion, a really big shame. And it's it's going to end up being a really bad outcome for so many investors, in my opinion. It's bad for the public, but advisors, when markets get tough, they want to be able to talk to clients and say, I know you're seeing this on CNBC right now or whatever. Hey, it's going to pass. It's not a big deal. Markets always go higher, right? If you have something like managed futures in the portfolio and you take an exogenous drawdown, just an exogenous shock to the portfolio, there's nothing to lean back on and just say, oh, well, I know exactly why, like there's no narrative always to just say like, well, it's because, Trump tweeted something, so he's going to taco and then this will go right back. It's trend under the surface. You might not own the same stuff a week from now that you own today in that fund, right? So like there is no promise that it comes back the same way. And that makes it a tough conversation because you can't lean on, well, hang in there. You got to lean on, hey, the quant data says. And what we know over time in this asset class is that you'll get a whipsaw and the trend will reemerge somewhere and it'll pick it back up and everything's going to be fine. That's so much more difficult to communicate to a client in reality. And so most advisors just say, not worth the hassle.
Why did we do this to ourselves?
Yeah,
why did we decide to do this to ourselves?
Well, I did it because
oh, go ahead.
I was going to say, I did it to myself because I do the math and I know what huge drawdowns do to people's lives. And I'm okay with uncomfortable conversations in good years. It's like, I call it a type 1 error. Type 1 errors are annoying.
I think that's a piece of integrity for you, which I also, try to have. And, I'll just tell you, when I was first getting into this, the advisor front, someone sat me down and said, Drew, I know that you are really a believer in sort of a more diversified investment approach than most 90% of advisors are doing. But I recommend you don't focus on that. I recommend you go with, I won't say the fund family name, and just go with that because it has a good story and it's easier to explain to clients. And I went home and I thought about it a little bit because this is an advisor who is a good advisor. He's doing great work for clients. Mm-hmm. And ultimately, I couldn't bring myself to do that because I don't think that is what is actually best for the end client. And though I haven't had nearly the experience that you've had in this space, I'm willing to take on that career risk because I got into this to be able to help people. So I don't want to give them something subpar.
Yeah. I think about it like this, like if you get a bad trade or a bad moment in the market history when the market is otherwise generally fine, it's annoying. It's annoying, right? If you lose half of somebody's money, that ruins their life, right? Like that's just the reality of it. That's like, and it's not it. And like, maybe I just have more ownership principle at my core and my core beliefs, right? And other people are just willing to say, well, it wasn't me. The market just went down 50%. That's like tough shit, like deal with it. I didn't do it. We just bought the market and the market went down, it's like, I just don't feel good about that. If I'm advising somebody to buy something, I don't want to advise somebody to hold on to something that I think is going to lose 50%. I'm not saying it will never happen. I'm not saying I'll never recommend something that goes down 50% or I'll never be in a trade that goes down 50%. But like, I just don't feel comfortable with the idea of being like, well, at some point it's going to probably lose 50%. Is that your first year of retirement or is it your last year of your life? I have no idea. Like I just don't like that. I can't stomach that kind of risk for people personally. And maybe it's because I work with people's life savings, right? Like I don't work with the super, ultra high net worth clients that are treating me as a hedge fund and, they're giving me a small allocation of some bigger portfolio piece. You know what I mean? I'm not participating in running an endowment fund for somebody. I'm not I'm not managing, and I'm also not managing typically $5,000 IRAs for people, right? Like I'm managing all of what somebody typically has to make their retirement happen and take care of themselves and keep food on their table in retirement. It's like I want to seek a good return. I want to get a meaningful, real return over time. And I want to not have a catastrophic life-changing loss at some point that takes their financial plan probability of success from like the 85 to 100% range to the 0% range, right? Like I like keeping that option off the table. And like that's different. And there is a ton, but I understand why people don't do that normally. The operational hassle and lift and the looking different and the tracking errors and like like professionally, it's a nightmare behind the scenes. Like it would be so much easier to just toss people in some funds and go play a lot of golf, right? Like I can't bring myself to do it. It's just me. But I think that's what, you guys like you and I, we're looking for. How do we get good return relative to the risk we're taking? And how do we avoid taking life-changing losses, right? And I think that's a meaningful endeavor.
Yeah. Well, it's cool to connect here and be with a fellow diversification head. I guess would that be what you call people that aren't bogleheads?
Diversification head.
I don't know. Yeah. I'll come up with a better name.
The Tracking Error Club.
The Tracking Error. Yeah. This is cool. I appreciate you having me on here.
Yeah, absolutely. Thanks for coming on and spending the time. And I'm excited we had the chance to kind of connect in person and instead of continually bantering over X. And hopefully we run into each other at some industry events or something coming up here in the future. That'd be fun.
Yeah, that'd be great. You have to let me know what you're coming to.